So there's a combination of factors that give us confidence in the equity markets. First, if we start with politics, so recent UK developments have seen the likelihood of a hard Brexit decline considerably, so that gives us a bit more comfort. Italy has had some political ramifications going on, and they have ended up with a more EU-friendly government, so at the margin that helps. And importantly, trade negotiations. So the US and China are still talking, and we believe the senior guys that are getting together next month in October, that we're likely to see some positive outcomes from. It probably won't be the silver bullet to resolve everything. However, there's strong incentives for both teams to get something moving, and so that gives us some confidence. Also, there is the central banks globally that continue to provide stimulus. So in the last couple of weeks, we've seen the RBA cut, with potentially more to come. We've seen the Fed this week cut rates, and then last week we had the ECB, who also increased their negative interest rate that they're charging, and also announced a new bond buying program, which $20 billion a month to buy, but also importantly, no end date. So this is an open-ended cheque that they're writing each month to buy that. So that's sending a strong message to markets of the political will there. There's also talk of fiscal stimulus from governments around the world, so another tailwind. Probably importantly, the US is where we see the most upside, and it's our favoured region. And we have a firm view that they're not having a recession anytime soon in the States. We have a recessionary dashboard that we look at, which has 7 indicators, and historically each of those indicators have pointed to recessionary conditions prior to the recession starting. As we look at that dashboard today, of those 7 indicators, only one of them is pointing recessionary, and that's the yield curve. So that's been a well-documented phenomenon where the longer dated bonds are yielding less than the shorter dated. And then we have 3 indicators which sit in neutral territory. So we have manufacturing. So US PMIs have dipped below that important 50 level. So they are contracting, but importantly, it's not a big negative there at the moment. It's in the 49 region. And the manufacturing part of the US economy is still a decreasing part. So the importance of services has been increasing for some time, and will still be a predominant factor. The second neutral indicator is housing. So recent housing activity has been not too strong. However, even more recent readings have seen some increased activity there. So that could change sometimes soon. And then corporate profits is the other one that's giving a neutral indication. So that's where we're looking at earnings that we're seeing out of the US corporates, and backing out buybacks for the next 12 months, earnings are likely to be flat. So that's certainly not a super positive environment to be in, but overall, the quality is still strong, so we're keeping that neutral. Then we have 3 indicators pointing to expansionary conditions, and that starts off with credit. And we see that there's limited stress in the loans market, so the non-performing loans are still at a relatively low level. Inflation is still benign, so that's keeping us comfortable. And importantly, employment. The employment numbers are still very strong, and a very much consumer-driven economy is likely to benefit as long as those employment numbers stay strong. So when we take all those factors together, we certainly in the last couple of years, recessionary risks are elevated from where they were, but they're certainly not high.